And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show.
Welcome to the show. This is Andy Webb with Lifestyles Unlimited, and as always, we're working on your financial freedom. Hey, and I want to, if you're new to the program, I thank you for joining today. Thank you for tuning in. I want to tell you today a little bit about what we do at Lifestyles Unlimited. We are 50,000 members strong, and we focus on real estate investing, single family houses and apartments. And we help those members get to retirement, financial freedom. In my case, early retirement in my 40s. I've been a member since 10 years. If you are new to the program, I'm in the Dallas-Fort Worth area. And 10 years ago, and some change, my wife and I joined Lifestyles Unlimited and started buying single-family houses. And more recently, we've gotten into the multifamily side as apartment investors now for a couple of years now. And I want to get a little bit more into what we do and how that can benefit you, especially as we're looking around the landscape right now with inflation and recession and home prices up or down, or what are they doing? I don't know. And in fact, what I want to do is look at a couple of recent articles with you. And one of those, well, let's just say it this way. Something is slowing at a record pace. What is it now? Is it the economy? And I want to use these articles to help you understand why real estate investing can benefit you, and why, as real estate investors, when you read this very article, you just kind of shrug your shoulders and say, well, moving on, it's not a big deal. And how adding one single family house can help you out. The second article we'll look at it's a little bit mind-boggling. Who is living paycheck to paycheck right now? And if we have time, I've got a listener question I want to get to. If we don't get it to that today, we'll hit that next week. But Lifestyles Unlimited, what we do, first of all, we were founded over 30 years ago. Del Walmsley is the founder of Lifestyles Unlimited. He's down in the Houston area, and the organization has grown dramatically over those 3 decades across Texas and now across the nation. In fact, I got into one of my first multifamily investments out of state just late last year, so a lot of opportunity, not just in Texas, but across the nation with realty offices, in fact, for example, now in Georgia, Tennessee, Arizona. So a lot of opportunity, and what we do is we help you become educated as a real estate investor, whether you're completely new to this or maybe you do have some experience. I interviewed an investor that is the lead, what we call a lead investor, the syndicator or general partner for multifamily investments. And he last week, he said, I did have a little bit of experience. Some buddies and I, we bought a house back in 2012. We did all the work ourselves. We fixed it up. They flipped it, right? So you may be like that. You may be coming from that avenue. You may even have some rental houses of your own already. And I find that when I have conversations with other members at Lifestyles Unlimited, say at one of the events, at a case study or one of the single family road trips, I hear it again and again. Yeah, I was doing okay. But boy, when I came in here and I learned some of the techniques and started following really the Lifestyles model, my business improved. My existing rental portfolio got better. Or I learned that, well, yeah, I've got a couple of dogs. Let's get rid of those and reinvest the funds. So that's what we do, is we help educate you no matter where on the real estate investor spectrum you may be. Now, if you come to Lifestyles Unlimited, we're not going to talk to you about Airbnb. We're not going to talk to you about retirement homes. You can buy a house, fix that up, turn it into a nursing home, skilled nursing facility. We're not going to talk to you about storage facilities. We focus exclusively on residential real estate, on single-family houses, and on apartments. Why do we do that? Well, if you think about Maslow's hierarchy of needs, everybody needs a place to live. People don't need that storage facility. People don't have to travel and use that Airbnb or Vrbo or whatever you see out there these days. But people absolutely need a place to live. They need air to breathe. They need water. They need food, a place for their family. Very, very high on that hierarchy. So that's why we focus on single family and multifamily. And as I mentioned, Del founded the organization over 30 years ago. So we have a very long track record, and we've been through a lot of cycles. And as you know, we're in a weird cycle right now. And that leads me to the first article. And I'm going to work in some of the philosophies that we have at Lifestyles Unlimited that help you be a successful investor. Del has 3 rules to investing. We're going to pepper those throughout this initial article. And, this article grabbed my attention. We live in a land of hyperbole right now. The biggest that, the record this, the record that, record slowdown, record increase in XYZ. And in this case, Home price growth slows at record pace in June. And I read the article. This was on Yahoo Money, and it's digesting. It's translating a lot of data from a company called Black Knight, and what they do. They're a technology analytics provider for the housing industry. So they have their pulse on a lot of what's going on out there, and they put that term out there as well, that the home price growth has slowed at a record pace. And nowadays, like I said, we live in a land of hyperbole. Everything is a record this and a record that. And at first blush, that seems alarming. Slows at a record pace. But what are we talking about exactly? Home price growth, right? The growth, the dollars I'm paying to buy my next rental property. Well, if that's slowed, maybe that's okay. Now, if you're planning on selling very soon, you may want those prices to remain high. So what exactly has happened? They report, Black Knight does, that home prices grew 17.3% year over year in June. Now, this is a national perspective. And as I just mentioned, we are buying nationally as single-family investors and as apartment investors. But please remember that all real estate is local. You need to dial down into your local submarkets. So home prices grew 17.3% year over year in June. What does that mean? And what is that record pace of decline in growth? Well, get this. Black Knight says we're down from 19.3%. That's a 2 percentage point drop, the largest since the 1970s. And I told you a little bit about what we do at Lifestyles Unlimited, and our target is to get you educated to become a successful real estate investor in single-family rental properties and apartments. That's our focus, none of the other stuff that's out there. A very, very narrow focus on which we've been focused for over 30 years and seen a tremendous amount of success. Our mentors, our operations consultant, all of the team are experienced alongside you there, and our bench strength is very strong. Just our membership base, 50,000 members. I can tell you, anytime I go to a case study, I meet somebody new and I learn something new, which is a tremendous thing. That's just an ancillary benefit. None of the formal education to speak of right there, just those conversations, which are very, very powerful. And I have a lot of conversations with people out there that aren't Lifestyles members, that are thinking about investing, know what my wife and I do, get excited, let's go to dinner, let's go to lunch, get a little nervous, read the latest news reports on the markets. And that's what we're looking at right now. This one caught my eye because it seems like a kind of a gloomy topic. Home price growth slows at record pace in June. Record pace. Oh my gosh, what does that mean? And this was published on Yahoo Money. This just came out a few days ago, start of the month, and you can find that there. More interestingly, perhaps, if you want to cut through all the fluff, let me give you the main source, because they're going to a company called Black Knight. That's KN, like as in medieval knight, Black Knight, and they've got their June 2022 mortgage monitor. So they're looking back a couple of months, right? They're not going to have their pulse on what's going on July just quite yet, so we'll stay tuned. We can see what they say there. And they pointed out, first bullet point, annual home price growth dropped by nearly 2 percentage points in June, down from 19.3% or 19.1% to 17.3%. That's still 17% growth in price year on year nationally. And again, as I stated, and it mentions here as well, localized slowdowns are even more pronounced. All real estate is local. Always keep that in your mind as you read any sort of national media. You want to be in touch with what's going on locally where you invest, whether you live there or not. You want to be in touch with what's going on locally as well. We have a lot of investors from the coasts, for example, that are investing here in Texas or in one of our other markets. Because the rental property, it just does not make sense on the coast. It is overpriced. You do not make money. It does not cash flow. And if you're following the Lifestyles model, and if you've heard Del Walmsley speak it all over the last 30 years, he has 3 rules to investing. Number 1, don't lose money. And in those more volatile markets, that's more likely. Number 2, it has to cash flow. And number 3, you can't get rich slow. But I want to focus on those first 2 with respect to this article, because again, you read this and you think things are tanking. You think things are cratering. And it is interesting because home prices have dropped in some markets. And again, specifically, that's going to be those coastal markets that were insanely inflated anyhow. In fact, the quickest cooling market here is in June was San Jose, California. Home values actually dropped 5.1%. from its recent peak of 1.56 million. That's a reduction of about $75,000 on a home price. That's California. If you're following the model we do at Lifestyles Unlimited, you're not buying a house for 1.56 million and trying to rent that out. That is not going to cash flow. People that are buying on the coast traditionally are buying as speculators. They're speculating that there will be appreciation. If that's your game, that is not the market for you. But if you're doing what we do at Lifestyles Unlimited, that's not your market anyhow. And they go on to cite a couple of other markets: San Diego, San Francisco, Denver. Denver's down 1.4%. But that's not where we're buying. We're buying right here in Texas. And what's really interesting is, and this is pointed out by both Black Knight and summarized in the Yahoo Money article, it's going to take another 5 or 6 months if the declines in price growth, let me repeat that, if the price growth continues to slow. It's still growing. That's the point. It's still growing. It's going to take another 6 months to get back to normal levels. What is a normal level? Annual appreciation of 5%. So they're not talking here at the national level, and certainly if they were to drill down into Texas, I'm in Dallas-Fort Worth, you're not going to see those declines here. Texas traditionally, if you go back pre-COVID, Great Recession, where we did have the housing bust then, they'll call it the housing bust, and we saw price drops in Texas as well. Nothing substantial, nothing like on those coasts. If you go back before that period, traditionally, price appreciation in Texas is around 5%, maybe even a little bit lower. It's a very consistent market. It doesn't experience those roller coaster up and downs like you do on the coast, like you see in your 401k right now, for example. So yes, there are some markets that are experiencing marginal declines. Those are those high dollar markets where we don't want to invest anyhow, because it has to cash flow, and they don't cash flow there. If you know anyone from California that's given this a go out there, talk to them. They're not buying out there right now. Now, they do go on to say price declines could be good news for would-be buyers. That's true. That's true. And this takes me to the first rule that Dell has: never lose money. And we are would-be buyers throughout the cycle. We don't sit and wait for those price declines to take down that next single-family rental property, because we make our own economy, as David Fisher puts it. We go in and we buy right. That is the key point. You don't pay market, you don't pay over market because you're hot under the collar to get your next investment done. You bide your time. You learn to buy right. And because we buy right, we buy at a discount. So even if prices, looking at, what was it, San Diego or Denver was down 1 point change in percent in terms of prices, that has zero effect on you if you've bought right. And when I say buy right, what does that mean? We may be buying a house that when it is fixed up and shining like a diamond, let's say it's worth $200,000, but we're not paying $200 for it. We're not paying $190. We're not paying $180. We're buying somewhere lower, maybe $150, depends on the repairs it needs. Maybe $120. I looked at a house recently that was listed, well, not listed, it wasn't on the market, it was off market, $80K. Needed a lot of work to get it to that $200K. But even if we put in all the repairs, do the renovations, let's say it's $70K, we're at $150 with a $50K buffer right there. So we buy right, and we create a safety valve of sorts with the price in mind. What does that mean for me? If prices do decline and I need to sell, I can sell and still make money. Never lose money. Rule number 1. Rule number 2, though, very, very important here as well, is that it has to cash flow. So if I come back to this article and it says, hey, it's good news for would-be buyers, well, what's the counter side of that argument? It's bad news for people that were considering buying. Why is that? Well, they're looking at prices dropping and they're thinking, well, I don't want to do that. And it's even worse for those that did just buy in those markets where prices are dropping. That is not here in Texas. But even if they do decline, what have we done? We've put an asset into place that we bought at a discount. We have a buffer, but we're collecting monthly rent. And if I need to hold a little bit longer until prices recover, if they do decline, well, that's exactly what I do. And by the way, and we've talked about this on prior shows, we're seeing an increased demand for rentals. People are not buying, cannot buy, so what do? They need a roof over their heads. They rent, and that's pushing up our rents and driving more cash flow to our pocket. Hey, stick around.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
Stop waiting. Stop sitting around. Stop procrastinating. This is your time. Make it happen. Do it now. When's the best time? Now. People go, well, I don't know. It's going to crash. It's going to be better next year. I've got to listen to 4 more classes. I love guys come up to me all the time. You know, I've been listening to you on the radio for 8 years now, right? I go, and you're not rich yet? Well, really, I'm thinking about joining next month. Do it now.
Learn the skills you need to retire with real estate in 5 years or less. Do it now. Register for the Lifestyles Unlimited free online workshop, lifestylesunlimitedworkshop.com.
Welcome back to the show. I'm your host, Andy Webb. And hey, home price growth slows at record pace in June. That's what we are reading about right now. This particular article caught my eye it was on Yahoo Money, Yahoo Finance, but it's sourced from Black Knight. That's with a Knight, Black Knight, and they help service the mortgage industry, data collectors, etc. Got a lot of good data, and this is from their June 2022 Mortgage Monitor. Interesting stuff. If you're following the industry like I do, that might be a good place to go and read. But as usual in our land of hyperbole right now, where it's the biggest that and the worst this, and are we or are we not in a recession? That's a whole other question, I guess. But home price growth has slowed at a record pace. Sounds bad, right? Record pace. Oh my gosh, what's happening? And for the newer investor out there, or somebody that's thinking about doing this, that may give you pause. But I want to continue here because it's interesting. They go on to say, yeah, we saw a drop from 19% and some change to 17% and some change, to 200 basis points roughly. Biggest drop in 40 or so years since the 70s, so 50 years, I guess. But they go on and say it's important to keep in mind that while the market is cooling, prices still hit yet another record high nationally in June. So again, that's nationally. What I want you to keep in mind as well when you are buying, when you're thinking about investing in rental real estate, that all real estate is local and it does make a difference where you buy. You can live where you want and invest where you want, because if you are on one of those coasts, it does not make sense. You can't lose money. You're at risk of that if you're buying for speculation, as so many people on the coast do. It must cash flow, rule number 2 that Dell has. You don't see that on the coast quite as much. Come to places in the Sun Belt. That makes sense. So think very, very hard about those markets. If you are getting into investing, you do not have to invest in your neighborhood, in your city, in your state. You can go across state lines. Again, 50,000 members at Lifestyles Unlimited. We're not all sitting here in Texas doing our investing. We got people from across the country and across the globe, in fact. Australia, Israel, Germany. I met a lot of national investors as well. So choose your markets wisely. And Texas, as we mentioned, we saw unusual appreciation, north of 20% in some submarkets here in the Dallas-Fort Worth area where I sit, which is unheard of since the Great Recession and especially since COVID-19. Normal markets in Texas, 5% appreciation, if that. Just a constant growth. I was relating to my 5-year-old the other day, the story of the tortoise and the hare. You all know the story. The hare they're in a race. And the hare, he's fast, clearly faster than the tortoise. Run as fast as he can. Takes a break. Hey, I'm way ahead of that guy. I'm gonna relax. Falls asleep. You know the story. And that tortoise is just plodding along at his consistent pace. He wins the race. That's what we see in Texas normally. Now, if you were an investor in Texas, if you're listening now, you have not bought your first rental house, this may not apply to you, even if we are still seeing, quote, those record prices nationally. We did see a lot of appreciation And that's the other thing, the other reason why we like real estate as an investment platform. We make money multiple ways, 5 ways in our houses, 6 in apartments. One of those, just one of those is appreciation. But if you've been around lifestyles at all, pre-COVID, pre-Great Recession, you'll know that appreciation is not our focus. It's icing on the cake. Hey, great. House went up 5% year on year in my first year of hold time. Great. Another 5%, another 5% after that. Superb. Now, if you got in 2012, 2013, 2014, you know we saw a lot of that appreciation, very, very strong. So you enjoyed that. That one of 5 ways that we make money on our houses really, really came to the fore. But all throughout that time, we continued to cash flow. It's another way we make our money. I already mentioned this. We buy right. We make sure we're not paying market prices. And we create a buffer. That's equity capture. That's what protects us if there is a bit of a decline. And of course, as we put residents into place, they pay our mortgage every month. So we have our equity buildup. And again, just focusing on houses, 5 ways we make money. The last would be our tax advantages. And those are tremendous. Those are tremendous as well. And the really cool thing with real estate is even if our appreciation, if you're new to the market and you just got in a couple years ago, you've been loving that appreciation in Dallas, Texas on your single family rental house. And if that returns from 20% down to 5%, so what? Because you got the cash flow. You bought right. If you're following the Lifestyles model, you created a tremendous amount of equity capture on the front end. I know a lot of people that doubled their money at the start of any given project by buying correctly. 100% return at the start of the project. Big, big thing. And of course, as we continue to hold, that equity buildup, quiet in the background, but can be an 8, 10, 12% return. And back to home prices and the fact that, we're seeing a little bit of a decline on the coast. We don't invest on the coast, so I'm not worried about that. Even if that happens here in Texas, and I don't think it will, I just hold my house for another year. Rents are coming in. I teased this heading into the last break. We are seeing an increased demand for rental properties right now. There is not enough inventory of rental properties on the market, whether that's apartments or houses, and that's pushing our rents up. So not only will I continue to collect my rent, my cash flow, as I wait, if I need to wait for appreciation to kick back in, for prices to return to where I want them to be to sell, right? If I've got a particular target in mind, I just wait. Time is on my side. I mentioned I'm in my 40s. I started when I was in my late 30s. If you start now when you're in your 20s, time is really on your side. And that's something to think about. Last part I want to hit from this particular article is they talk about inventory levels. I mentioned inventory with respect to rental property, with rentals as somebody that's looking to rent. There is a dearth of inventory. Well, there's still a lack of inventory in the broader housing market for those that are seeking to buy their own personal residence. Now that's creeping back up finally because interest rates are up and prices are up. Fewer and fewer people can buy. Read that as renters. But fewer and fewer people can buy. Therefore, houses are sitting a little bit longer on the market. Now, what does that mean, longer on the market? Here in Dallas-Fort Worth, boy, Austin, Houston, San Antonio, we were sub 30 days, meaning if I put my house on the market today, I can expect it to be back off the market and sold in under 30 days. These things were just flying off the shelves. They're not doing that under 30 days anymore. We might be at about 60 days, 2 months. Very, very fast. Traditionally, again, to harken back to the normal times, and this is a national number you'll hear about quite a bit, a normal market has 6 months worth of inventory. That means my house can sit out there for 6 months once I put it on the market for sale. So right now, overall inventory, this again goes back to Black Knight, overall inventory increased from this is national, by the way, 1.7 months worth of supply at the start of the year to 2.6 months as of June. And as they put it here, at least 6 months of inventory are needed for a balanced market. So a little hyperbole here, home price growth slows at record pace. Sure, the biggest decrease in growth of home prices since the early 1970s, 200 basis points, but still a 17.3% increase year on year in June. So when you read these articles, keep several things in mind. Number one, is this a national picture? Do I care if I'm buying right here in Dallas, Texas, or Houston, Texas, or Corpus Christi? What's going on in my market? That's the bigger question. And in Texas, in this example, if it's Atlanta, Georgia, around Atlanta, I keep seeing Macon. I talked about Macon on an earlier show. Boy, Macon just keeps popping up on my radar again and again and again. Chattanooga. Shout out to Chattanooga, Tennessee. I like that Tennessee market. Great place to visit, but boy, good place to own some rental property. If you have any questions, I had a listener question. I hope I get to this in this segment. It's again my favorite topic, property tax protesting. Yeah, I had a big success earlier this week. If I can use my own hyperbole, it was a record. Yeah, it was a record. I did very well actually in front of the ARB. I'll relate that to you if I have time today. If not, we'll take that up on a later show. But I do want to get to some of the hyperbole in the market. That's what we've been talking about in the news, in the media. Home price growth slows at record pace. Look, if you are holding rental property now, understand that prices are still very, very high. If you have a rental property that you need to divest, it's still a good time to do that. Prices are still high. They are not dropping in Texas. Now, it may take you a little bit longer to find that buyer because, as we just heard, inventory levels are creeping up, but they're still very, very low, well below a balanced market. So the ball is still in your court if you want to divest. What if you want to buy? Well, the good news may be that price growth is slowing. But does that even matter? It does not matter if you buy right. And we talked about that already. We're going to buy at a discount. We're going to find off-market properties. We're going to find properties, both houses and apartments. This applies to both. We're going to find properties that are distressed. And because they're distressed, either physically or the seller, we're able to get those at a discount. And if I say put $20,000 of my own money into a property, I may very well get 100% return out the gate. We call it equity capture just by buying right through the process. So now I'm sitting on $40,000 in equity. Does that protect me if markets decline? Yeah, sure. If I feel like I need to sell for some reason, I've got that buffer. We never did see the declines in Texas back in 08, 09, 2010 like on the coasts. Maybe 20% decline. Very short-lived. Came roaring back. I enjoyed that appreciation wave. Icing on the cake, but boy, it was big. It really was. Normal appreciation, as we mentioned, is about 5% here in Texas. And we make our money multiple ways. That's the other point I wanted to make for you, is that even if that appreciation does decline or return, let's say, return to normal, so what? It's just one of the ways that we're making our money. I put bigger focus when I go into a project on that capital gain, that equity capture on the outset, and that rent that I'm going to bring in. Those are my focuses. When I'm reviewing an apartment investment, I was on a webinar just last night. That's what I want to learn about, among other things, but that's my part of my investment criteria. What is my gain? What is my return? And we talked about Dell's rules to investing. Rule number 1, never lose money. That goes back to equity capture, that buffer, buying right. Rule number 2, it has to cash flow. I don't want to be paying that house every month just for the right to hang on to it. I'm losing money in that sense. Rule number 3 is you can't get rich slow. Well, what does that mean? That means if you are sitting on rental property, don't sit too long. Divest that and get into the next 2, 3, or 4 houses. You sell one, you should be able to get into multiple. Or upgrade into apartments. But keep moving. Don't just sit. Don't stagnate. You have to keep investing and building that portfolio, getting those better assets. If you're in apartments, that might be going from Class C to Class B. Continuing to work on those gains, getting more units, getting bigger, more investors. And going back to the cash flow, it has to cash flow. I want to look just quickly at an article here that caught my eye as well. This was on Bloomberg. And it blew my mind. A lot of stats out there. Maybe this is more hyperbole. I don't know. It says one third of Americans that are earning or making $250,000. So of those Americans that are earning that size of a paycheck, at the household level, that's $250,000. One third of them, I cannot fathom this. One third of them live paycheck to paycheck. These are people that are bringing in a tremendous amount of cash, a tremendous amount of earnings, that are turning around and going right back out the door. That's what that means, paycheck to paycheck. They may not be living below their means, but they're living at a minimum right at their means. I have trouble understanding that. As Somebody has recently retired. I will tell you, I never earned anywhere near that. Our household never earned anywhere near that number. And we managed to live below our means. We managed to buy double-digit houses. I mean, a good-sized house portfolio to retire my wife and then myself on considerably less income. You can do it too, by the way. And it goes on to say cash is especially tight for top earners of the millennial cohort. There's a graphic in here, people that are earning 100 to 150K, 63% of those that are millennials are paycheck to paycheck. For some reason, they got millennials versus boomers. Boomers, you should be retired, but 26% of you guys in that 100 to 150K are also living paycheck to paycheck. If I just jump ahead to the 250 and higher, $250,000 in earnings and higher, over half, 55% of millennials are paycheck to paycheck. Listen, when we talk about residential real estate, we talk about it must cash flow. Every house that I buy, every apartment investment that I get into cash flows. And that adds to my bottom line. If you are living paycheck to paycheck at that level, you got to do something. You've clearly got the income coming in. You've got to take some sort of action, because if you keep that going down to where you are in that boomer status, you will have problems. And if you're not in that 100 to 150 or 150 to 200 or 200 to 250 or 250K plus category, you can take action too. It starts with one house. And if I think again back to inflation, I had another article queued up. We don't have time today, but talking about inflation, and it's out there. We know that if you're on the lower end of the income spectrum, you get impacted proportionally higher because more of your income goes to things like food and gas and utilities and housing expenses and all that stuff. These guys that are in the 250 plus category, a third of which are not, they're living paycheck to paycheck. They've got other problems. Organizational, I don't know what it is. If you're in that category, you can take action as well. If you've got a good income, is that going straight to apartments? You may have to figure out how to address the fact that you are paycheck to paycheck. What is that? That is bills, that is toys, that is things that you're putting your money towards. Maybe a very, very expensive house, and it's the biggest factor in here. If I read the article, we're not going to go into the details today, but that's the biggest factor. Take some action to downsize, to reduce some of that debt load, and start to shift those funds, because you're earning very well, into houses and into apartments, and start to do what we call cash flow snowball, building a cash flow snowball. If you've got that toy that you absolutely love and you have to have, and it's costing you $500 a month, go find a single family house that's going to cash flow $500 a month. And when that comes in, you take that to pay down that toy. Even better, get rid of the toy, take the capital, get into apartments or more houses. But over time, build up that cash flow snowball and use another notion called cash flow chunking, and take that chunk of money coming in from one house to cover a debt. And then next house to cover the other debt. Next house to cover utilities. And over time, you'll find that this notion of living paycheck to paycheck, whether you're making $60,000 a year or $250,000, that goes away. Because you're now covering that outflow from that passive cash flow. It's very, very easy to do. Again, Lifestyles Unlimited has been doing this over 30 years. Founded by Del Walmsley 30 plus years ago, 50,000 members strong. We have a lot of successful real estate investors that have retired themselves, that have followed the cash flow chunking method, that have created and built that cash flow snowball, and that are not focused on the fact that, price growth in houses may be declining a little bit. In Texas, that does not mean prices are down. Let's keep buying. Let's keep adding to that snowball. But it does take some education. It does take knowing what is that lifestyles model when you say buy right, don't lose money. Well, how do I do that? Well, if you don't know how to do that, you do want to learn how. Best place you can go is go to lifestylesunlimited.com. While you're there, check out the radio tab, check out our archive shows. But there's also a button that says attend free workshop, hour and a half of your time. We have those going on midday as well as in the evenings, but we'll get into how we make our money. We talked a little bit about the 5 ways today, but they'll go into more detail there with houses as well as apartments, and just give you a flavor for what it is we do and how we educate you. Very, very important, so that you are buying right, so that you're not one of those guys that has 3 or 4 houses and kind of learned on his own, the painful way, falling down, losing a little bit of money here and there, finally coming to Lifestyles and learning the correct way to do it. Like I said earlier, I talked to so many members that went that route. For you, pass go straight to Reading Railroad and get the education. There's no reason for you to learn the hard way. Learn the right way. Learn how to buy right. Never lose money. Make sure you have cash flow. And understand that you're not going to get rich slowly. Even if you make $250,000, especially if you're living paycheck to paycheck. That just, again, blows my mind. But there are actions that cohort can take as well. And it starts with the education and building up those passive cash flowing investments in houses and apartments. So I've run out of time to get to the question I had from the listener on tax protests. The good news is it's not a time-sensitive thing. His question was, I bought my house out of the cycle after the protest window closed. Can I still protest? Yes, you can. Yes, you can. And here's my promise to you. We will talk about that on next week's show. I told him I'd get to that. He got my answer already, but I want to give that to you as well so you understand that the battle is not over. If you just bought your first rental house and you bought it at a discount because you bought it right and you're way under the value they have you on those tax rolls, yeah, you can do something about it. And I'll tell you how. So we'll talk about that next week. I do thank you for listening today. The big message today is ignore that national media. Read it, perhaps, I guess. Get some of those stats if you're like me, a numbers guy. But understand, all real estate is local. And if you follow Dell's rules to investing and understand that we make our money not just 1, but 5 ways with our houses, 6 with apartments, you will find that road to financial freedom. Get away from living paycheck to paycheck. Hey, have a good day.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented